Hello everybody and welcome to the Like a Tortoise channel once again. Today's video is on Salesforce and whether or not I think the company is a buying opportunity at current level. Some of you have been asking me to analyze this company for a while. I noted it down, and now more recently one of our new group members have asked me to do the same thing. So if this interests you, stick around because I will do a deep dive into the company, business model, how they make money, whether I think management has skin in the game, past growth rates, and whether I think the company is priced attractively at current prices. Okay, so but before I delve into today's video, I just want to make you all aware once again that we have our second live call on the 31st. So at the end of this month, it's going to be a great opportunity for some of you guys to just ask me anything related to investments or whatever you want to ask me about. So just make sure you mark that in your calendar, okay? Because it's going to be great to see you on the other side. So you have been supporting the channel. Our number of subscribers continues to grow since we launched the channel just a few months ago. So thank you so much for all the support. Okay, now let's talk about what really matters today, Salesforce. And first things first, every time I delve deeper into the company, the first question that I ask is, hey, do I know what the business model looks like? Do I know how these guys make money? Because that's really the most important thing. And there are so many information. There's a lot of information out there. And so I just put everything or summarize the main findings into a document. I was doing some research on this over the weekend. So I do hope you guys find it insightful, and I will be sharing this with our community members as well. But if you like me to send you the report to you, feel free, to join both our WhatsApp group or Skool communities because it's entirely free, okay? And all right, so without further ado, let's hop in. Hope you like the logo. Okay, cool. So what is Salesforce? So first of all, many of you know this company, right? But what you probably didn't know is that the company was founded many years ago, actually in 1999, and it was founded on a simple but disruptive idea: enterprise software should live in the cloud, not on on-premise service. So what started as a basic CRM tool has evolved into a global enterprise platform serving 150k plus businesses across virtually every industry, generating about 40 billion plus in annual revenue. Today, Salesforce software sits in the operational backbone of many organizations, integrating sales, service, marketing, data analytics, collaboration, and of course AI into a single ecosystem that helps companies manage customer relationships more efficiently and profitably. And if I zoom in on this document, you can see how these guys. Look at that. So it's quite diverse, isn't it? And they integrate all of this that you guys can see above. And I like that because it will make the software stickier, as we will discuss as well. And that is definitely one of the main competitive advantages. Okay, but you can see, look at that. So the ecosystem is quite broad. Yeah, and they do a lot of acquisitions as well. So we all know Slack. Many of you use Slack on a daily basis, and you probably didn't even know that it belonged to Salesforce. But yeah, so it's what it is. So I like that. I like the platform. Okay, it's quite diverse, and it serves different aspects of a business, which is very good. Now let's talk about the business model. It's a platform, not a product. This is important to understand. So it's not a single product company. It operates a cloud-based platform offering a suite of modular products that customers can adopt incrementally. So the key characteristics of the model are low friction to start, cloud-based subscription pricing, high long-term value if used effectively, and here we go, rising switching costs as more products and data are integrated. So the more Salesforce is integrated into businesses across every industry, the stickier it gets, right? Core platform components, we already discussed some of them, namely Slack, but look at Tableau. Tableau, I hope I'm pronouncing this correctly, analytics and collaboration embedded into workflows, data cloud and MuleSoft. unify data across systems and applications, end-to-end customer, this is service and marketing cloud, end-to-end customer engagement and support, Sales Cloud, the original CRM powering global sales team, and Einstein AI, Agent Force, embedded AI for automation. Of course, as a software company, they are integrating AI applications across the business, which makes a lot of sense. But you can see right here that one of the main highlights that I have right here is that each additional product, this is important, deepens customer dependency, making Salesforce harder to replace over time. This is the definition of a sticky SaaS platform business. And by the way, if you guys didn't know, Salesforce is actually one of the is credited with starting the SaaS business model, the software as a service business model. So they have the first mover advantage as well. And this give, if you operate in the software space, you are always subject. You are always at risk of disruption, of course, but being the first mover advantage always gives this company a jump start, right? Cool. So how do they make money? Because that's important. So 94% of revenue comes from subscription and support services. I love that. And if you've been watching the channel, this is something that I really like, because it creates what, guys? Predictable cash flows, which is very important, especially if we think as business owners, that predictability and consistency over time is going to make our job much easier for sure, not least because it's easier at the time of calculating the intrinsic value of a company as well, okay? Multi-year enterprise contracts provide high revenue visibility. Expansion revenue, adding more clouds, users, or data volumes is a key driver. Professional services are offered, but not the core profit engine. So we have recurring revenues plus long contracts, both of which create what? Predictable cash flows, which is a core like a Tortoise attribute. Now, granted, not all of our companies have that in the portfolio. So not all of them have this the recurring revenue model, especially considering that this is, look at that, about 95% of their revenue, right? But this is definitely something that I really love, and it's something that is a common attribute among SaaS businesses, right? Because they offer the software as a service, and they that allows for so what the user will have to do is just to pay them consistently to use the software. Okay. So what are the main competitive advantages, and what's the moat here? Do I think they even have a moat? Because that's important. Market leadership, global number one CRM provider with deep enterprise penetration. They have established many contracts with many companies, and that is very important for them. Okay. High switching costs. CRM sits at the heart of operations. Migration is costly, risky, and disruptive. If you were to ask me what the main competitive advantage of Salesforce is, what I would say, switching costs is definitely the key, the most important one. And in my opinion, switching costs is also one of the strongest moats you can find. You can find because, for example, Oracle. We all know Oracle, right? Look how integrated look how integrated these services are into every business we know. It makes it very sticky, right? Switching costs. So the costs to actually change that operator are very high. People just can't be bothered. Not only that, it can be quite costly as well. Ecosystem and network effects. Thousands of third-party apps on App Exchange reinforce platform lock-in. Integrated data and AI. Salesforce owns both the system of record data and the system of action workflows. AI is embedded across products, not as a standalone add-on. Financial scale, strong free cash flows enables buybacks, acquisitions, and reinvestments. Okay. Also, we will be talking more about this as well going forward. But let's pause a bit and let's look at what the data is showing, what the financials are showing us in terms of margins, for example. And so if I go here to, let me just minimize this. Let's talk about, for example, if I go here to the financials, and if I go here to the metrics, look at, ideally, you know that I want to see either consistency over time across all main or margins, right? Or I want to see margin improvement as the company scales. And if I click here on gross margin, you can see that, for example, going back to 2017, look at the average, about 74. The latest is about 77, but this is expected, right? Because this is a SaaS company, and so the direct costs are quite low. So it makes sense for the gross margin to be stable. Okay, that's a positive. Now let's talk about operating margin, and this is where we start talking. Okay, this is very, very important. And you can see that the operating margin has exploded substantially since 2022. Okay, so this is very, very good. The business is becoming more efficient and more efficient as it scales, and it's controlling the operating costs as well. I like to see that it's becoming more profitable as well. Look at net margin. It's a bit bumpy because of earnings. But if I, so you can see that since 2023, it's gone up quite a bit, but it's quite bumpy. I don't like to see that. And the reason, but you can see that the average is 8 right now, is at 16. So I don't think we can read too much into this, because if I go to the income statement and if I show you the earnings, you can see that they are quite bumpy as well. In fact, they crashed substantially since 2021, and only since 2023 have them actually starting to go up. The question we have to ask, guys, is this trend going to continue? So if I zoom in further and I show you the trailing 12 months, in fact, if I show you the quarterly data, look at that. Since 2023, it looks like the company is increasing the earnings more consistently, which I like that, but still, we don't have many years of data, right? So this, I would mark this as a red flag. And if you are going to invest in Salesforce, this is something that you should understand. Okay, why have the earnings been bumpy all the way up until 2023? I can see that this was a company that was still scaling, many quarters of unprofitable earnings. Not my style, okay, but understand why this happened and whether you think this trend, this recent trend is set to continue. Okay, cool. So we are done as far as metrics are concerned. Let's go back to our PDF right here. Competitive event, we discussed that. So what are the main growth drivers for the company? Salesforce is transitioning from a high growth disruption to a mature compounder, okay, where discipline matters more than expansion at any costs. And in fact, if I show you this, look at total revenues. You can see, for example, if I just do until 2021, you can see, for example, since 2012, that revenues have compounded by almost 30%. Now, if I do this over the last 5 years, you can see that revenues, for example, going since 2020, have slowed down quite a bit. So it's no longer the super fast grower that used to be. But sure enough, this allows because the company is maturing and is now achieving operating leverage as well. Okay, and this will allow it to deliver cash to shareholders, which is always a positive. Let's continue here. Where discipline matters more than expansion at any cost. Key long-term growth levers: AI native CRM, Einstein GPT, and Agentforce embedded into customer workflows, data cloud expansion, unifying customer data. Silos is a massive cross-sell opportunity, margin focus, efficiency programs, and slower headcount growth, driving operating margins towards 30+%. 30% plus, and we saw that. In fact, if I show you this, guys, let's have a look at selling, general, and administrative costs, administrative expenses, and you can see, if I do this on a yearly basis, you can see the CAGR is about 10%. since 2020, and you can see that total revenue is about 17.23. So I like this fact. I like the fact that they are controlling the operating costs related to the business, and this includes, for example, costs with personnel, marketing, selling, administrative costs, as you can see right here. So I like that, and that's why I mentioned that right here. Enterprise stickiness, long contracts, we already discussed that. Ecosystem leverage, partners extend their reach. So despite its size, Salesforce still has multiple levels to grow, but both top and bottom lines, which is very good. What about management team? You can see that Mark Benioff is the founder, chair, and CEO, visionary leader in cloud software. In fact, if I show you this right here, if we go here to the Insight tab, you can see that, for example, ownership and show only company executives. You can see that the CEO is also the co-founder and the chairman of the board. So we are talking about an owner operating company, which I love. Okay. And sure enough, look at that. We are talking about a lot of skin in the game. He owns about almost $6 billion worth of stock, which is substantially. Okay. But not only that, look at this guy. Aris G. Parker, also a co-founder of the business, and he's also the CTO. And he owns about $500 million worth of stock, which is also very good. But you can see that you have a lot of high insider ownership, not just among CEOs and not just among executive team members, but also across the board, which is very good. And let's have a look at insider transactions and see if they have been buying stock now that we are in a downturn. And you can see that I see some selling right here. I only see selling. Well, I see some buys right here as well. Um, Nothing. Yeah, I've been seeing some selling. Okay, look, there are many reasons why the executives may sell. However, there are only reason why they would be buying, and that is because they think the stock is going to go up. So overall, I hardly see any buys, but I do see a lot of selling, and I don't really like that. But it's just something to keep in the back of your mind. All right, so we have high insider ownership, which is also good. And all right, so let's go back here to our document. Presidents, okay. So recent years have seen a clear shift towards shareholder returns, cost control, and capital efficiency. Speaking of which, let's see what the stock-based compensation is. This is a software company, so software companies need to attract a lot of bright minds, and one way they have to attract them, one tool is to provide them shares, right? To award them on top of cash incentives. They can also issue shares and give them to the employees. That's good, but only up to a certain point. When you see stock-based compensation eating up a lot of cash flows or revenues, that can be a red flag. I don't like that. Ideally, I like to see stock-based compensation under 10%. That's it. But the lower the better. Some companies only do cash incentives, but it's what it is. Let's check what we have right here. How do I do that? I go here to the metrics tab as well, and I can see, so this is the yearly. Let's see. Yes, so I see share-based compensation as a percentage of revenue is at 8.40. Look, what I really like about that is that it's been declining. So it declined from 2023. That's a positive sign. And now it's at about the same level. Let's check the trailing 12-month periods right here. Yeah, so it seems to be declining, which is very positive in my opinion. Let's have a look at, so look, the share-based compensation as a percentage of operating cash flow is high. However, it's also declining, and this ties into what we were saying about the company being more shareholder focused. That's very, very important. Okay. So overall, it's been declining. I like that a lot. And so yeah, this is definitely a positive. Okay, let's have a look at the diluted shares outstanding. Have they been diluting existing shareholders? Let's change this to the yearly. And now let's go back to 2014. So there was some dilution because they were in a growth stage. Since 2014, the number of shares have increased by about 62%. I don't really like that. It's a lot, as you can see, but I mean, because they do a lot of acquisitions, right? So probably they had to they issued equity, diluted, so that they issued equity in order to use that cash to fund new acquisitions. That's why the diluted existing shareholders. What you have to understand is whether or not that has created a lot of shareholder value. And judging by the stock price, this has been a good compounder, right? So the good thing is that if I then zoom in, and for example, since 2009, yeah, it's still increased by about 25%. I don't really like that. Okay, I don't like that. Let's see if they have been doing buybacks to offset some of that dilution. Net common stock issued. Yes, they do, which is very good. Look at that. Since 2022, so they have been ramped up share buybacks, which is also very good. This is exactly what we want to see, especially now that the stock is trading at a more attractive valuation. But still, it's not really ideal. I like to see, as you guys know, I'm a conservative investor, and I really like to see more years of good financial data. Okay, so I don't like to see all of this dilution, but not to say you cannot create more value for sure. But to me, that's just a red flag. And so if I go here to insights, you can see that the stock unlocks flags this as a red flag, flags this as a warning sign, right? So look at the share base, they say it's bad, but then of course, operating cash flow 23%, it's still very bad. But this is common in the software space, and it's not something that I really like. So yeah, it's just what it is. Financial highlights, look at that. We already discussed operating margins, strong operating and free cash flow generation, large goodwill balance from acquisitions weighs on reported ROIs. This is important, guys. Okay, so the company, as you know, does they do a lot of acquisitions, and one of the metrics that I really pay attention to, and in fact, for those of you who are watching this for the first time, is the most important metric of all, and it shows us how well management can can use money, so can use capital invested in its operations to generate net operating profits. In other words, this is the return on invested capital. If I go here to statistics, let's go to financials. As a matter of fact, let's go to ratios and let's go to annual. And you can see that ROIs, this one right here, right, it has been exploding since 2023, which goes to show that companies becoming more efficient, as we discussed. Okay, it makes sense if we compare this then to the margins and all of that. So the company has been becoming more efficient with its money, and that's why ROIC is going up, but it's low, and we don't have any consistency here over time, but it's in the right direction. This is exactly what we want to see. But the problem is it's only happening since 2023. Okay. In fact, you can argue since 2022, because we already see a nice jump here. But we want to see this go well above 10%. It's a software company. Okay. So all the allocation metrics have been improving, from return on equity to return on assets. So yes, I like to see that. Okay. The company is in the right, going in the right direction. So that's a positive. And yeah, but again, the reason for that is exactly because of the acquisitions that the company has done. And why is that? Because look, when a company acquires a lot of businesses, they probably do so using, for example, debt. Yeah, if they borrow, they have to take on debt from the bank. Alternatively, another thing they can do as well, they can issue new shares, and that dilutes existing shareholders, but it allows them to have funds, yeah, to use without borrowing debt. Okay, without borrowing that from the banks, because that's the most That's the most pernicious type of debt that you can have. So some businesses just decide to issue equity. And and so what that does is it may take years for the company to actually achieve returns on the money that they borrowed, and so that of course compresses compresses some of these metrics that we discussed, like the return on invested capital. Cool. So let's carry on. We discussed that. Look at the 10-year CAGR metrics. Revenue per share about 16%, which is good. Ideally, we want to see this at or above 10%. Earnings per share, we don't have a percentage because it was negative in 2015. And so we don't have a CAGR figure, but you can see that the improvement was substantial from minus 0.4 to 6.9. That's good. Free cash flow per share has compounded by about 25%. Okay? And this is what you can see. This is what it looks like. Look at that. How cool is that, right? So very, very good. This highlights the operational leverage that we discussed a short time ago, unlocked as Salesforce scaled. So the company scales. It has become the costs to actually scale the business can be controlled, and that creates operational leverage, right? Valuation. Let's talk about valuation right now. Share price has been largely flat over the past 5 years. In fact, I can show you that right here in the charts. If I go back, you can see that right now we are here at about 230, and you can see that since 2020, right, the stock has gone nowhere. Meanwhile, earnings per share compounded by about 14.92% per year, and revenue compounded by about 14.72% per year. So as these metrics, the fundamentals improved and the stock remained flat, what that translated into was a major valuation compression. And sure enough, what happened? Well, you can see if I show you if you can see that the forward PE at one point was at about 90, and right now the forward PE is at 20.58 times earnings, and the free cash flow yield expanded from 2.5% to 5.29% at present. So from a historical perspective, Salesforce is trading at a far more reasonable valuation than at any point in the last decade. Okay, this is important. So, what are the key risks? In fact, let me go further. Let me expand on the valuation. And let's say, let me minimize this. Let's say let's do some quick math here. Let's say we want to double our money over the next 4 to 5 years, which is the goal, right? So we want to compound our money at least by 15% per year, which means we are doubling money every 4 to 5 years. So with the stock currently at about $250 per share, for us to achieve that, the stock would need to trade at about $520 per share. Let's assume the P, which is right now at about 34, but the forward is at about 20. This is still, I still believe the company with so much growth potential will still deserve at least, I assume they will be trading at a PE of 20 over the next, in 5 years' time. So if I do 520 divided by 20, that gives me an earnings per share in 5 years of about 26 times. The current earnings per share is at about 7.49. So let's do the math here. If we take 7.49 and we input 26, what am I doing here? Bear with me, sorry about that. Okay, let's go back to our video. And if I put here 26 earnings per share in 5 years, I'm going to get a CAGR of about 28.26%. Okay? So what you guys need to ask is, do I think it's reasonable that, so what we need to ask is, do I think Salesforce is going to be able to compound its earnings per share by about 28% over the next 5 years? And if you think that is the case, then the current price is justified. In my world, that is certainly not the case. Okay, so I don't really like that. And you can see, but look, then again, earnings have been a bit bumpy. So you should take that with a grain of salt. It's not the only metric that you should analyze at all. All right. But for example, we can even do this exercise for free cash flows. What's the current free cash flow of the company? And the free cash flow per share, I'm not sure if we have this right here. Let me see. If we have, that would be great. Yes, we do. Look, free cash flow per share is at, you see, it's about 13.76. So what else do we know? We know that free cash flow per share is compounded by about, let's go back to our sheet right here. Free cash flow per share is compounded by about 25% over the last 10 years. But what about over the past 5 years? Over the past 5 years, take a look at this. This is free cash flows, right? So free cash flows since 2020 have compounded by about 29%. Let's assume, okay, keep that, all right? And now what we're going to do is we're going to go here to Salesforce, take again the 520, right? Divide the 520 by the multiple of free cash flows, and let's assume, for example, what has been the multiple since the last several years. Let's check the price to free cash flow ratios. So the price to free cash flow ratios right here. Do I have that here? No, I don't seem to. Wait. Right here, price to free cash flows ratio. So it's been around, look at that, 50, 26, 28, 26, and now it's at 18. Let's give it a 20 as well, okay? Because we want to be conservative. So if we do 220 divided by 20, once again, we get our 26, right? So now what we have to do is we will take the free cash flows, the current free cash flow per share. Right, so if you go here to statistics, let's take this metric right here, 13.76. And if we do 13.76 and our end value remains, say, 26, right? And if we do that, you can see that you have a price. So it means this. What this means is that the free cash flow would have to grow at about 14% over the next 5 years. Okay, 14% CAGR for us to double our money in the next 5 years, and this is from free cash flows, not earnings. And so again, the question, this is a lot more doable. What we need to understand is whether or not we think this is going to happen. And by the way, don't forget that because they do a lot of share-based compensation, what a shareholder, a wise shareholder will do is you have to subtract the stock-based compensation from the free cash flow and get to an adjusted free cash flows. And what that will do is it will significantly lower your free cash flow levels. And in fact, I can show you that right here. Look at that. Free cash flow, if we do so with stock-based compensation included, you have about 12 billion. But if you exclude stock-based compensation, and you should, because share-based compensation is a cost for shareholders and should be treated as such, you only have 9.666 billion. Okay, and what that means is that this will significantly, it will ultimately, you have to achieve a much greater CAGR than this. And in my world, that won't be sustainable. So look, guys, in my opinion, while this company still trades while this company trades at a more reasonable valuation level going back to many years, this is still expensive in my world. As you know, I want to buy high quality businesses with a big margin of safety. I don't see that in Salesforce right now. But let me know in the comments below if you find this video insightful, and if you guys want me to delve deeper into, for example, some of my valuation metrics. By the way, I will share a video this week on my reverse and my DCF and reverse DCF model for you guys to to go through, and I will make that template available for all of you as a big thank you. Some of you requested me that, so I will gladly do so. So, yeah, guys, look, I hope you managed to enjoy. Stay tuned for more and have a great rest of your day.